kids coming out of college today, in general, not everyone, of course, are having a tougher time. And that was one of the things I meant when I said the employment data looks to be fairly strong, but beneath the surface, that's not quite the case. The birth-death model makes assumptions in the current month, and that gets revised later. So I don't think employment is as strong as it looks, but it's still strong enough to keep the flows up. So we either need a diminution of inflows into the market via the passive bid, which would imply that employment growth needs to slow down even more, or unemployment needs to accelerate, or people that are retiring need to take more money out of stock. Some combination of that has to affect the supply and demand balance. And thus far, from what I've seen, from what Mike's had to say, who is kind of the person I rely on reading about to see where we are, it's the size of the flow is shrinking, but it's still enough. Now, will that change at some point? Yeah, probably. And you'll have to be alert to clues that that's happening. And then the market will trade differently, like it did last April.
Mm-hmm. How critical do you say it is to understand the passive bid force in the markets? And does it also matter maybe across like age demographics, like understanding that force and what that might mean? Because I'll say this, like, I have a 401k, my company has a match. Like I'm probably just gonna like not do anything about it because I'm in my mid 30s. Like I don't know. I probably wouldn't do anything about it, but does it matter more so demographically?
Well, I think it always matters for you to understand, to make it a little, but this is a little less serious, but you need to understand the game you're playing, right? Mm-hmm. So investing isn't a game, but the rules that are at work, or that are the driving force that revolve around the passive bid, are different. That wasn't a consideration maybe 15 years ago, certainly not 20 years ago or farther back than that. I mean, if you're a 25, 30, 35-year-old person, do you really need to understand this? Yeah, I think it's important because, it may be such that if you understood it and events started to unfold in a certain way, you might change your allocation for a time, and you might save yourself a good deal of losses, right? I mean, it's not something you can tinker. It's not something you want to tinker with without a good deal of thought. But I think it's important to understand what's driving things. So that you don't learn the wrong lesson. You might think that, wow, I mean, because Nvidia sells for this and Apple sells for that, and these big tech stocks sell for that, you may get the wrong idea about how markets really work and about how investing really is. There has to be some return on your investment. You have to see some math that'll suggest that'll work. When you look at a lot of these big companies, that doesn't make sense. It doesn't matter. There's nothing about valuation or investing that makes sense if you look at the valuations of some of these companies, especially the really big ones. And they are where they are because of the passive bid. So I think it's important to understand that so you don't learn the wrong lessons, because over time you're liable to become an investor. Maybe you won't. Maybe you'll always be involved, through your 401k plan, which is to say passively. Although somewhere in the next 15 years, 10 years, maybe 5, that's all going to blow up in a big way. I don't know exactly what's going to come together to cause it to happen. So that'll change. But I think it's important to understand at least some of the basics of investing. And if you don't understand what the market structure is, you can't learn any valuable lessons. You'll only learn the wrong things,
Yeah. We probably don't even realize like what we even own. That's the other thing with the passive. I couldn't even tell you. I don't know.
If you're involved in any kind of a passive investment program, your three biggest holdings are probably Apple, Nvidia, and Microsoft, those are certainly 3. I mean, so you're way skewed to these big behemoths, because that's what's got the big weighting, and that's why the prices are reinforced by the buying, because these are capitalization weighted indices, basically.
Yeah.
So your biggest positions are the most overpriced tech stocks on the planet, which, oh, by the way, go up every day. Yeah, well, I have a very low opinion of the Fed, not because of them personally, but because of what they have aided and abetted, so to speak. Greenspan started us down a bad path in the 90s by getting overly captivated by productivity and kept rates too low too long. We had a stock bubble. It burst. Then their policy was to try to bail that out with low interest rates, and there was an obvious housing bubble which they cheer led, and then we had a bust there, and that brought us to QE, and then as QE has been tried 2 or 3 times in the last 15 years, along the way, that's when the passive bid started to build, and the QE and the passive bid kind of reinforced each other. And so what they've allowed is enormous can kicking on the part of the Congress, right? One of the reasons we have a $36 trillion deficit and no one feels any pressure to do anything about it is because, we haven't had the normal downside of things you would see in a recession, because the recessions have been a function of asset bubbles that have burst. And because it was so catastrophic, the Fed rode to the rescue. So they kept postponing it, not to say people didn't lose jobs, 01, 02, or 09, 08, 09. But nothing lasted all that long. And so lessons weren't learned, behavior wasn't modified, the government didn't learn anything. So, and that's part of what's led to the massive bifurcation of wealth in the country. It's not capitalism. It's having a central bank that's done what these guys have done, an irresponsible Congress, which is almost by definition what you get out of politicians, and the combination of the Fed, the Congress, and the passive bid have created this sort of this feeling that financial markets, nothing can go wrong, the economy can't really get too bad, and so you've had this enormous distortion of equity prices, and some people have a lot of people have benefited, but if you didn't have any capital, you didn't benefit, right? So it's this will sound silly to some people, but a lot of the financial and economic distortions we face in the country today is a function of meddling on the part and the pursuit of easy money that has been part and parcel to the Fed policies ever since Greenspan. So that's one of the reasons we're in the predicament. If the Fed hadn't done what it had done, we might have had deeper recessions, and the Congress might not have gotten away with being able to just keep kicking the can down the road in terms of the budget deficit. Now it's too big to fix, maybe. I mean, Doge came in, looked like they were going to do a whole bunch of good, and kind of all fizzled because there's so much pushback in the Congress, and so the deficit's out of control. And I don't and when Bessent first came in and Doge first showed up on the scene, maybe it was going to be possible to make a big cuts in government expenditures. That turns out not to be the case, and they don't really think they can finance the bond market sort of in a normal way. So they've now tried to push everything to the short end, which I talked about a minute ago. So the Fed has caused enormous damage, and in real time, no one, very few people believe that. I mean, I have friends who believe the same thing because they look at the world the same way, but a lot of people don't make the connection. So that's kind of where we are. Yeah, the Fed definitely has mission creep. They had, and obviously the lunacy of spending $2.5 billion on a renovation. I don't know the details of that, but I mean, that just goes to show you the arrogance of the Fed and having 200 PhDs on this. I mean, come on. I mean, yes, mission creep. They've embarked on that on top of all the really serious problems they've caused, which I've just kind of described in shorthand. Yeah, I don't know about those projections because I don't know how they're arrived at. Bessent's right when he talks about the Congressional Budget Office, quote unquote, scoring and how they do all this stuff. I don't know how that number's derived, so I don't have any real sense of how accurate it may be. But for sure, we have very large contingent liabilities, and with the baby boomer generation, now hitting their peak sort of the peak years of potentially drawing on Medicare, not so much Social Security. That's liable to increase the size of the budget deficit, given how much healthcare spending happens when people's hair gets gray or their mind or falls out.
Yeah. And then just looking again, these are prediction markets that we look at. Just for this year, the forecast is 39 trillion. I don't know that. I mean, these people who are placing bets on where they think these things are headed, but
that sounds high to me. But I can't say I haven't spent a lot of time trying to look at those sorts of projections. It's because I don't have any confidence that I know what policies we're actually going to follow through on.
Yeah. You mentioned earlier, and I thought this was interesting, I wrote this down, the bond market is the big story. And I know this is a space that you know really well. Can you kind of frame up what's happening in the bond market, that big story? And you were mentioning just kind of what they're doing at the short end of the curve and inducing buyers from these banks. Can you kind of frame it up a bit more and explain it for us? Because that was interesting.
Well, the bond market is the big story. I mean, that was the big question I had. Would the bond market sort of sit idly by while they tried to gun the economy strong enough to try to grow our way past it? Obviously what Bessent decided was that they couldn't do that. So therefore, they decided that they're going to issue more debt at the short end, which is what Janet Yellen did too. It's not what's in the best interest of the country. I mean, we had 0 to 2% interest rates. They should have financed the daylights out of the debt at the 10, from 10 and 20 years out and termed out the debt so we wouldn't have to keep rolling it over. But they didn't do, the Biden administration did not do that. And now this Trump administration doesn't want to have to pay the rates that they'd have to pay somewhere probably between 5 and 6 if they started really financing at the longer end. So the bond market, they've tried to sort of anesthetize the bond market by pushing all the supply to the short end. Well, if the banks can leverage themselves up more, they're going to pay overnight rates, and then they can own 2 or 3 year paper and earn the spread. And so, again, based on what I read, that may unleash, say, $3 trillion of new buying. That's a not an insignificant number. And then if you lower rates, you can create an even, then that makes obviously the interest that you're paying on the debt smaller. So that component of the deficit is smaller. So their game is going to be to try to roll the short end of the curve. Roll as much debt as possible in the short end of the curve, get lower rates down, and hope they can hold it there long enough to grow the economy past it. Basically, they're trying to inflate the debt away. Well, normally when you're trying to inflate the debt away, the people that own the debt behave in a way that make it not possible. Yeah, but I mean, it's tricky. If I wanted to be an ideologue, I would say that's bad policy, and no, they shouldn't do it. They should set rates where they are. They should go back to what Volcker did in the early 80s, which was control the money supply to some degree. But that's if you're living in an ivory tower. As a practical matter, we have this massive deficit, and we have to figure out what to do about it. Bessent's approach is perhaps the least bad alternative if you grade it from the viewpoint of creating the least amount of pain. I think it's going to produce inflation. It may turn out to be a better outcome than basically you just saying, no, we're going cold turkey. But in order to pursue that sort of policy, you'd have to control the Fed and, the Treasury. So there is no good policy that's going to be painless enough to be acceptable, given the fact we've let things get so far out of control. And almost certainly there's going to be more inflation. I mean, and that is what they basically want to do is they want to grow past the debt. They want to inflate the debt away. They can't say it like that, but that's exactly what they want to try to do.
Which I imagine, okay, that if they want more inflation, that's going to be painful for a lot of folks then.
Yeah.
I don't want to say it out loud, but yeah.
For the average American citizen, it's a very bad outcome. The average person would probably be happier if they just said, if they stopped this nonsense. And but the Fed can't say, okay, we're not going to finance government deficits. They could pick an interest rate. I mean, you could have a Fed chairman who is determined to try to put an end to this sort of thing. That's not what Powell's trying to do. I think Powell's more of behaving the way he is because he doesn't like the current administration. You know, they like the prior one, they don't like this one, and it's been pretty obvious. So he's been reticent to cut rates, whereas before he was pretty much ready to do it at the drop of a hat. But if the Fed wasn't allowed to print money ad nauseum, if we were on some sort of a standard where there was money supply or gold, which we're not going to go back to these things, but if you examine the environment with that from that perspective, you can kind of see where you might be. If we did that, rates would be higher. The economy would certainly get weaker. We'd have to cut government spending. We'd have to cut these programs, and of course, that would create all kinds of outrage. Look how politicized everything is today, especially with the media fanning the flames. The media doesn't know anything about anything. They have an agenda and they go with it, right? So if you tried to pursue the exact right policy, it'd probably blow up in your face. You wouldn't be able to. So then you got to pick a policy that's not quite as bad, but it's worse for more people. So we let this get too far out of control. And that's what happens when you print money to solve problems, incrementally over years. We've been doing it now for, since Greenspan started in the mid 90s. Well, this has been building up for 30 years.
So it all goes back to the Fed.
It all comes back to the Fed. Yeah. Because the Fed if the 2000 to 2001 recession had been allowed to kind of run its course, remember what happened in the middle of that was 9/11. And so that took the focus off the Fed having created an equity bubble that burst. And so then everything kind of changed around that. Then we round up the housing bubble. And when that collapsed, that almost took the banking system with it. People forget that the Fed was supposed to be regulating those big money-centered banks / brokerage firms. And they not only were cheering real estate, and Bernanke and Greenspan were saying that real estate can't have a bubble, can't experience a bubble. They didn't manage the banking system, so the banking system almost vaporized. So then we came with government programs and money printing. So every time the Fed was about to be in the penalty box for their prior policies, something else happened, right? And then when COVID came along, they decided to print money with QE again, which is what they did after the 2008 mess. So they create all these problems, but then they get viewed as my friend Jim Grant likes to say, they get viewed as the firemen when in fact they're the arsonist and the fireman, but they don't get penalized for having been the arsonist in the first place.